Hi, friends. Senate Eskridge here. I'm really excited to have you on my webinar today, where we're going to learn the basics of passive investing. Uh, those of you that know me know that I like to start on time and end on time. And here we are right at 3 o'clock Mountain Time, which is when this is supposed to kick off. So let's dive right in. So those of you that don't know me, my name is Senate Eskridge. I am a syndicator, a fund to fund manager, and a coach. And I just absolutely love helping people just like you learn about how to do passive investing and to move your money out of the roller coaster of the stock market into these much better. I'm sorry, maybe not better is not the right word. My opinion, they are better, but definitely less volatile and higher return opportunities in passive investing through syndications and fund of funds. So let's talk first about the challenges. What do people like you, the high net worth investors, face? What are the problems, right? So, as I already alluded, stock markets and public markets, they're very volatile. They typically, at least especially in the last couple of years, they've had pretty decent returns, but ups, downs, all that kind of stuff. There's just this big roller coaster of them, and they're very unpredictable. And the typical lower volatility things like stocks or like bonds and savings accounts, they have very low yields. And you just have no control over your investments, and they have very little tax advantages, right? So, what do people that are looking for these stable income producing alternatives have to turn to? What are your options? Well, we'll talk about that in a minute, but first, let's talk about like some of the goals, right? That these typical high net worth investors, people like you and I, what are we looking for? Well, it says right here on the slide, right? So, capital preservation. This is number one. There's a great book called The Number One Rule of Investing, and basically what it is don't lose your principal, right? So we got to keep the capital preserved. And then, of course, create this consistent passive income. How do you do that? Obviously, in the traditional stocks and bonds type of portfolio, you can invest into dividend producing stocks and bonds of things of that nature that produce consistent cash flow. But as we talked about on the previous slide, a lot of those things, those yields are a lot lower than people need. And then portfolio diversification. This is something that's really important. In fact, I don't think enough people pay enough attention to diversification, and they don't really understand what it means. I could do a whole webinar on this one topic, and definitely should have had a whole slide on it. I'm regretting not putting that in there, but something that is just as important, if not more important than diversification, is correlation. So what that means is if one stock or one investment, rather, if it moves a certain percentage, a certain amount, how much do the other things in your portfolio move similar to that? Well, and a good example is the S&P 500 is the 500 largest stocks in the S&P, or in the stock market in the US rather. And Google is something like 10% of that capitalization rate in the S&P 500. So what that means is that whatever move Google makes, the rest of the S&P 500 is going to move approximately 10% of that one thing. That's if nothing else changed. So again, approximate here, this is not exact math, this is an example, but let's just say Google drops 10%, everything else stays exactly the same. The S&P would drop approximately 3%. And again, approximate. But the big problem with it is the other things are going to move with it too, right? So the S&P starts to drop, the rest of the stocks are going to drop too. So you're not going to see like a 3% drop, you might see like a 5% drop. And so the whole point of this, when you talk about portfolio diversification and correlations, is you want to have as many investments that are truly as uncorrelated as possible. And again, we could do a whole webinar just about this topic, but if you're in a traditional stocks and bonds investment, check your portfolio correlations and see how much things move together. The other one is tax efficiency, right? So there's been a lot of heat about some of these people in like politics and stuff that weren't paying taxes because they knew how to play the game, right? And the thing is, those tax rules apply to you just as much as they apply to these super rich people, right? And so we got to learn how to make sure that you know all these rules just like everybody else. So what are we going to talk about today? Today we're going to talk about, again, the basics of passive investing. What does it mean to invest passively? So we're going to cover these bullet points. How do syndications work? Multifamily is the example we're going to use today, but syndications in general work very similar. What are the roles of all the people involved? How do you make money? What are some common terminologies that you need to have in your vocabulary? And then what to look for when choosing between a syndication and a fund. So let's talk about a really good example, the alternative, and how we do all of these things with the multifamily syndications. Now, we can do this with just about anything, but the elevator pitch or the example that I like to give on what a syndication is, right? So I believe anybody can buy a duplex and rent it out, and then you become a landlord. You got to deal with the troubles of real estate, tenants, toilets, termites, all of those things. But if you wanted to buy a building like the one's pictured here, let's say it's a 200 unit apartment building, you need a big team of people, some special skills, and a lot of money. Well, the way syndication works, what my team does is, we have the special skills, we have the team of people, and then we pool people's money together. We take a little bit of your money, a little bit of this guy's money, a lot of that guy's money over there. We pool it all together, and then my team buys the real estate. They run it. They do all the work, and you get to kick back and just enjoy the benefits of investing in real estate without any of the work. This slide talks about a few of the benefits, stable income from rental demand. So you get to participate in those rents. They're inflation resistant. In fact, when you own a hard asset like this, one you can go up and touch with a fixed rate debt, inflation is actually on your side. So this puts you on the right side of inflation. And then there's tons of tax benefits. We're going to get into that a little bit more detail, more specifically later on, but they're huge. The tax benefits are one of the biggest benefits. So what is a syndication really? You know, there's some specific things in here, but really what you need to understand about what is a syndication is a pool of people, a group of people that come together for a common result, right? So we put people together that have a product, have a building, and they can run it, but they need your money. And so we all come together for the common good. And so the bullet points here that talks about this private investment structure, that's something to really understand. It's important because these things are not publicly traded, right? You can't just go into your stock account and buy and sell these things. uh, Multiple investors, it's not going to be just your money. And led by experienced real estate operators, these are the people that know what they're doing and can run a deal. Something really, really important to have, these professionals on your side. So what are some of these people, right? So let's talk about the two primary groups between these groups. So you've got the general partner over here on the left and the limited partner over here on the right. The best way to really understand the difference between a general partner and a limited partner is where the risk is involved. Okay. So if you invest in one of these, you become a limited partner. And the best way to understand that is your risk is limited to your investment that you've made. There's so many different layers of protection, insurance and LLCs and contracts that really say, if you let's just say you put 50 or $100,000 into one of these deals and everything goes wrong, your risk is the amount of money you put in. So you could lose the 50 or $100,000, right? But there's a huge upside to it. Now, the general partner, if the limited partner takes a very limited risk, the general partner takes general risk. And they're the ones that are signing on the loan, they're the ones that are doing all the work, they're the ones that are putting up the risk capital before you can ever invest into one of these deals. So you have limited risk, they have general risk. All right, so why do they exist? The real reason for you is access to these institutional assets. It can put you on the same playing field as groups like BlackRock and these other huge Wall Street firms. Now you have access to the same level of detail that they have, right? You get into these big, larger deals with experienced operators, and you can diversify your money across multiple different investments and multiple different types of assets. So how do they work? What's the life cycle of a deal? All right, well, let's talk about this. This is a really basic timeline, but when we find the property, we go through this exact process. We acquire the property and then we improve the operations, we stabilize the asset, and then we either refinance it or resell. At the bottom, it talks about the typical range of deals. I would say the best thing to do is to imagine every deal is 5 years. Some are going to be a little shorter than that, some are going to be a little longer than that, but I would say that's about the average. I have seen them be as short as 2 or 3 years, as it talks about on the slide here. I've even seen them longer. I've participated in a couple of deals that are 10-year deals, which is a long, long time in the syndication space. Again, the average is about 5 years. All right, so what are some metrics? What are some things that you need to know? So we're going to talk about these four terms here that you really need to know. The first three really are all measures of return on investment or ROI. They're all different ways to calculate money in versus money out. And so they are calculated different ways, and we're going to walk through them. But we're going to start with equity multiple, the third one on the list. Honestly, because it's the easiest to understand. If you take all the money that you put into this deal and you take all the money you receive from the deal throughout the entire hold period, you add all that together and then do a comparison of how much money you put in to how much money you're total getting out. That's your equity multiple. Okay, so the goal is typically to double your money every 5 years. And so if we've doubled your money, that's a 2x equity multiple. Hopefully that makes sense, right? But the problem with that is it doesn't talk about, time or any of the things that you're getting throughout the hold period. It just talks about how much money you total in and total out. Cash on cash or average cash on cash talks about the amount of money that you're going to get as an average throughout that hold period. So it brings time into the equation. So if you take that equity multiple and you use that 2x equity multiple, and you just straight line it across a 5-year hold, that would be a 20% average cash on cash. So because 100% return divided by 5 is 20. Pretty simple, pretty straightforward, okay? But internal rate of return, the top one on this list here, it includes the time value of money. So money that you get today is worth more than money you get in 5 years. Simple inflation. Everybody should understand that. So if you have a 2x equity multiple on a 5-year deal, your average cash on cash is 20. If there's any cash flow that you get throughout the hold period, let's say in year 1 you get 5%, in year 2 you get 2%, then in year 3 you get 7%, and so on until they get to the end, and then they catch up the difference. Your IRR will be higher than 20 because you got more money earlier on in the deal. All right, so that's the first three: IRR, cash on cash, and equity multiple. These are all return metrics for you. Debt service coverage ratio, or DSCR, what this is how much money they're making every month in comparison to their debt payment. So obviously you want this ratio to be as high as you can. If it's a 1-to-1, it's par, it's parity. So the debt payment and the profit or the NOI that they're making are equal. You'd have a 1.0 debt service coverage ratio. That's not great. You really want to see something much higher than that. So like a 1.2 debt service coverage ratio would mean for every dollar in debt that they have, the payment, they have $1.20 in income, net income after expenses coming into the property. That 1.2 is typically what banks are going to require. I'd love to see it a little higher than that, 1.25, 1.3, maybe 1.35. These metrics really help help you evaluate a deal. All right, so now let's talk about something else that's really important called the capital stack. So the capital stack really is all the money it takes to do a deal. And I'd really like you to imagine this in a triangle or a pyramid, right? And it's actually inverted in comparison to this, but the senior debt, this is the bank loan that they get. These people always get paid first. The senior debt has the first position lien. Those people are always going to get paid first. and they can take the property away if they don't pay it. Mezzanine debt, this is if they're getting a second mortgage. So let's just say they go to bank A, I don't know, call it Wells Fargo, right? That Wells Fargo gives them a loan, let's just say for 60% of the purchase. But they're going to get a mezzanine debt from another bank, call it US Bank. US Bank's going to come in and give them another loan for 20%. So now they're at 80% total of the purchase price in debt. Okay, that's what a mezzanine debt would be. And these aren't super popular. You don't see a lot of mezzanine debt. You see senior debt first, almost always, and then sometimes mezzanine debt. And then on top of that is something called a preferred equity. Now, we're going to talk in a minute about preferred return, and I want you to keep that separately. They both have the word preferred in it, but there's preferred equity and preferred return. Keep those separate in your mind, please. Preferred equity, what that is when you get an equity infusion from a large institutional buyer. Let's just say again in this example where they had 60% senior debt and 20% mezzanine debt. What if they go get 10% of the purchase price or of the equity needed as a preferred debt? Now, these come in the next position above mezzanine debt, so they get paid third in this example, and they can typically get a higher interest rate paid to them, and sometimes they get a little bit more control in the deal. Why would a syndicator use this? Because they are actually cheaper than giving somebody a profit split. You know, these preferred equities, they're usually going to come in and they're going to take a fixed percentage payment, just like a debt payment, 10, maybe 12, 15%. The payment's going to be much higher, but they don't have to give away a profit split on the end typically. That's the reason they would do it. So it's cheaper for the operator to use preferred equity over investor equity. And investor equity is what comes very last at that tip of that pyramid. And the investors are the people that typically get paid last in this capital stack. So their money is at risk, but they also get the highest potential upside of all of these people. So this is where your money usually sits. You get paid last in the capital stack, but you have the highest potential for return. All right, so let's talk now. We talked about preferred equity. Let's talk now about preferred return. So a preferred return, simply what this means is that if you get a preferred return, in this example says 6 to 8% annually, what that means is that you, as the investor, are going to get paid this preferred return before the general partnership receives any money, okay, before the profit split, which we'll talk about that in our next slide. But, let's say it's 8%. You have to get 8% before they do that profit split. Well, what if the property only pays out 5% in that year? Well, if you have an 8% preferred return, they owe you the difference, the 3. And now that'll get stacked on the next year. So in year 2, they didn't pay you 3, they already owed you 8, so you add those together. So now you are owed 11% on your original investment before you do that profit split, before the GP makes any money. These things are very cool for investors. However, I'm seeing preferred returns as an industry kind of going away. I'm seeing a lot less and less of those things. Anyway, good things to do. It helps align the incentives and keeps everybody on the same page. So after you get your preferred return, now you start looking at a profit split or a waterfall structure. Now, what this means is we go back to that slide earlier where we had general partners over here and limited partners over here. And you see this 70-30 or an 80-20 split. What that means is that a portion of the profits after the preferred return are going to the general partners and the limited partners, the other part. Typically, the most common that you're going to see, the larger side of the split, goes towards the investors. Now, I have seen it the other way in unique situations, but usually you can take the bigger number and say this is where it's going towards the money. Okay, so in this case, the 70-30 example, 70% of the ownership would be going to the money or the investors. And the 30% would be going to the operators that are actually doing the daily work of running this property, again, on a daily basis. And so that's to pay them for their sweat equity. And again, none of this, if there's a preferred return from the previous slide, none of this ever gets paid out. until that preferred return has been satisfied. All right, so who's going to actually run these deals? Let's start talking about that. What's important? Who's literally running the deals? So the sponsorship team, these are the people that are putting the deal together and running it on a day-to-day basis. So list the different bullet points here, but they find the deal, they structure the deal, they get the financing, and they run it. I mean, there's a lot more work to it than this, you guys. Um, putting together the PPM or the actual business plan, that legal structure, costs a lot of money and takes a lot of time and tons of meetings with attorneys. Getting loans, it's not like a single family house, guys. It takes a lot of work to put this together and just to put the business together. But then there's the day-to-day of running it, and that's what we call the operator, who's actually boots on the ground running it on a day-to-day basis. Now, this is talking a lot about property managers and the people that are literally in there every single day. And property managers are one of the most important aspects on a deal. Who's going to be the property manager that's literally running the day to day, doing the leasing, maintenance, repairs, overseeing improvements and financial performance? These are the people, again, property manager, right, that are dealing with the tenants. But there's another thing that's really important that's missed between these two slides, right? Talk about the sponsor team and the operator. One of the most important jobs, if not the most important job on one of these deals, is the asset manager. A good way to describe what an asset manager does, and property managers hate it when I say this, but basically, property asset managers manage the property manager, right? Their job is to make sure that the manager is doing their job at the end of the day. So a great question is, who is the asset manager, or what's the asset management team look like on this deal? If you're vetting a deal, that's one of the most important questions you can ask. All right, so what about you? What is your role as an investor? All right, so I really say that there's three jobs. There's three jobs as a passive investor once you're in the deal, right? So you've got to do your due diligence and all that, and we'll do a whole nother webinar on how to do due diligence on one of these investments. But after you have invested your money, you have three jobs. The first job is to read the update when it comes out. Sometimes these are monthly, sometimes these are quarterly, but this is your money, and you need to take responsibility to understand how your money's performing. And by the way, if you're not getting investor updates, reach out to the sponsor, right? I actually got one earlier today and found this guy was upset. It's how come I'm not getting your updates on this deal? And it turns out all of my emails were going in his spam folder. I've been sending them, but he just hasn't been seeing them, right? So that's the first job. The second job is to deposit the money in your bank account when you get it. Sometimes they're monthly checks, sometimes they're quarterly checks, sometimes they're annual checks, but you've got to get them into your bank account. And then the last job at the end of the year is to provide the tax document to your CPA. It's called a K-1. It's kind of like a W-2 from a job, but this is the name of the document you get in a syndication. It's called a K-1, a partnership document. And by the way, if you ask me really nice, I'll do the last two for you. I'll deposit the check in your account, and I'll even send the K-1 to your CPA. All right, so how do we wrap all this up and get the interests aligned, right? So one of the most important things to ask, another one is, how much is the sponsorship team investing alongside of the investors? I love to see 10% of the equity going in from the sponsors, but sometimes on these bigger deals, you guys, it's not possible for them to do 10%. Maybe they can only do 5% or 1%, but it's important that they do have something in there so that their interests are aligned with yours. All right, let's talk about money. How do you make money? All right, so there's three ways these deals make money. So the first one, this top one here, you can see, pretty makes sense. Cash flow distributions. And so the cash flow that you're going to get on one of these investments really depends on the type of investment that you're going to make. I've got one deal that I'm working on right now that pays a 15% cash on cash paid out every month. So what that means is you get 1.25% of whatever money you've put into it paid out every month. That's a really high return. You're not going to see that on a lot of deals. If you get into a multifamily deal, right, especially if it's a value add multifamily deal, you might not get any cash flow from distributions for the first year. And then maybe in the second year starts at 5% and then goes up to 6 or 7 or 8. But it's pretty common in residential syndications where the cash flow, there's no cash flow in the beginning, or it starts off really modestly and then starts to slowly grow. Um, but the real wealth is made in property value appreciation, right? So these things go up in value as we increase rents, renovate them, make them better, and can compress the cap rates down. But you can't really access that money, that property value appreciation, until you have a capital event. And it says here sale or refinance. I love to do refinances on properties because if I've increased the value enough, I can go out and do a refinance and give you all of your cash back, but you still own the property. Now, in today's interest rate environments, that's a lot harder to do, but it is something to look at when you're looking at one of these syndications. Is can you get that money back early? And it's something to really think about. But a lot of things now are just selling, right? And so 4 or 5, 6 years down the road, they sell the property, and now you get all of your preferred distributions caught up, all your cash flows caught up. You get all your money back, and then the total return on your money. And this is really where we're looking at that doubling of your money every 5 years. The next slide talks a little bit more about cash flow. We talked a lot about that already. I'm going to skip over that. Like I said, sometimes they start off modest and grow. Other times they could start off high. It just depends on the investment. Forced appreciation, we talked a little bit about this, but these are some of the ways that we can force appreciation into these deals, right? So renovating a unit so we can rent it for more. That's an option. Just improving the property management, taking a bad property management company out and putting in a new one can significantly improve the profit of a building. Operational efficiencies, basically what this is talking about, lowering costs. There's tons of times when we've gone in and we've put new low flow toilets in or replace all the light bulbs, anything we can do to lower the expenses. Another thing that's not listed on this slide is ways to increase income, but also increase client satisfaction or tenant satisfaction. Let me have a drink real quick. One of my favorite stories in how we increase and force appreciation. I had a 33 unit property, fairly small, and all of the tenants had crappy internet. I mean, real crappy internet. And they were paying like $90 a month for basically dial up. It wasn't very good, but there wasn't a lot of other options for them. So we were able to bring in a fiber optic internet line that covered the entire property and then spread that out throughout all of the units. And we charged the residents $50 a month for this internet fee. And it only cost us like $15,000 to put it in. Well, because the way these properties are valued, it's all based on the profitability of the property. Getting $50 a month times 33 units increased the value of our property somewhere in the tune of $400,000. And it only cost us $15,000 to do it. So there's lots of ways that we can force that appreciation. But then we already talked about capital events earlier. When we sell or refinance, this is where we can really tap into that equity that we've built up. All right, so I alluded earlier to tax advantages. Let's talk more about this. So there's lots of different ways that we can write things off, and there's lots of tax advantages in multifamily and lots of different kinds of real estate. But the biggest one is depreciation. And so I want to talk a little bit more about how depreciation works and how you can get the benefits from these cost segregations and bonus depreciation. So if you bought a single family rental, well, actually anything that people live in, the IRS says that you can write off the value of the building, not the dirt, but the building, over 27 and a half years. They call that straight line depreciation. But they will allow you to accelerate things that are only going to last 5, 10, and say 15 years. But to do that accelerated depreciation, you have to have this cost segregation study, right? This thing that right here. And what that is where you bring in an engineer, special engineering firm. They're both CPAs, accountants, and engineers. And they break up all the building components into how long they're going to last. And then they put them into different buckets. Five, this is five, this is 10, this is 15, this is 27 and a half. And now you could accelerate all those things in those buckets in those timelines. But there's this really cool thing called bonus depreciation. It started to go away for a minute, but now it's back. And basically, you can write off everything in the 5, 10, and 15-year buckets in year one. So sometimes you can invest into one of these deals and get 50, 60, sometimes even as much as 90% of your investment back as a deduction on your taxes. And you guys, there's a lot of rules on how you can use those deductions. That is not what this webinar is about right now. But so be sure and talk to your CPA about how you personally can use these deductions. All right, so now let's move over into how to evaluate one of these properties. So, these are some key areas that we're going to talk about, right? Sponsor quality, market fundamentals, and business plan assumptions. So let's dive in first to sponsor due diligence. When you're talking about a sponsor, the person that's running the deal on a day-to-day basis, these are four of the most important things that you can ask about that, right? So track record, how many deals have they done, right? And even better, have they gone full cycle on a deal? So have they taken investors' money and completed their business plan and returned money? And how did that work out? And you guys, this isn't a hard requirement for me because sometimes there is a newer operator that's doing really good deals, but they haven't done the full exit. Track record's important, but I don't necessarily always exclude somebody because they haven't had an exit. Communication and reporting practices, probably the most important thing, because I'm going to say that a lot. I don't know if you've noticed, I've said this is important, because when we're talking about due diligence, everything's important, right? But you've got to understand how they communicate and how you're going to get the information about your investment. And then have they been through multiple market cycles? You guys, the real estate market and investment market follows cycles just like the stock market. You're going to see times of up, you're going to see times of down, and they've got to be able to be successful in all of those different categories. So sponsor is, again, very important. More important, I think, than market, which is what we're going to talk about next, because I do believe that a really good sponsor can do well in an average market, and a bad sponsor can't do well even in a great market. Okay, so these are four things that I look at when I'm looking at a market and I'm choosing to invest in a specific market, right? And really, it's about growth, right? These first three things are all about: is this a growing market or a shrinking market? And so, is population growing? Are jobs growing? With jobs, also are wages growing? And is there a strong rental demand, right? So, are people moving into the area? And then limited supply. I want to talk about this because honestly, this bit me a couple of times. I missed this in the very beginning of my investing, and it's something I want to make sure you don't miss. And that is, what is the supply that's going to come on in the next 2 or 3 years? And by supply, I mean similar units of similar types. So if you're investing in apartment buildings, how many more apartment buildings are planned in that market over the next 5 years? And you can get this data through multiple different sources, CoStar and things of that nature. But really what they're doing is they're looking at building permits. So if you're going into self-storage, you want to see what kind of self-storage square footage is coming online in the next few years, right? So very important to understand this market. All right, so next is the business plan. I could spend an hour just talking about how to review business plans. But really, these are four areas where you need to understand. So, and really what I would recommend you do is just have a gut check on these things. So ask, what are your rent growth assumptions? And ideally, you look at their spreadsheet where they actually put it in there. And the question you're, again, looking to ask is, do they make sense? On average, rents are 2 to 4% across the country. So if they get in there and it says it's like they're going to get 8% every year, obviously doesn't make sense. So you got to figure out why they're saying that. Similar things with expenses, right? You want to go in and see, are their expenses growing with what you think inflation is going to be? If you think inflation is going to be 3%, their expense growth should also be 3%. So if you get in there and it's 1 and you think it's 3, there's a dilemma. Exit cap rate, again, I got to spend more time on this, but basically the cap rate, what a cap rate is the formula, part of the formula we use to value one of these. So you should ask, what is your going in cap rate versus your exit cap rate? And again, I could teach you for an hour on this and how they work, but basically what you want to see is that the exit cap rate most of the time should be higher than the entry cap rate. So what that means is that they're being more conservative on their exit assumptions. If you see it the opposite, the beginning cap rate's 5 and the exits say 4.5, 4.5, ask why. Why is the exit cap lower than the entry cap? And maybe they have a good reason, but this is something you want to ask about. Same thing with capital improvements. This is the renovation, you guys. So what is their renovation plan and what is the budget and does it make sense? If they're saying that they can completely renovate a unit for $1,000, I'd be really shocked, right? And also, if they say they're going to spend $20,000 renovating a unit, I'd be really shocked. You should see this somewhere between 5 on the low end, 5, and on the high end, 12 or 15. And again, different markets and things like that are going to have a different rate. But really, it's a gut check here, you guys. What does it make sense, their business plan? All right, so how do we mitigate the risks? Again, how do operations mitigate risk? Adequate cash reserves. Basically, how much cash do they have just in case? Conservative leverage. So this is that debt stack we were talking about earlier. What you see most of the time in the market is like say a 70% loan to value or LTV. That means that they're borrowing 70% of the purchase price. So to be conservative, you want that percentage to be lower. I've seen it as low as 50% on a really conservative deal. I've seen it as high as 90% on really aggressive deals. Solid debt structure. What this is really talking about is what are the debt terms on the loan? Personally, I prefer to see fixed rate debt for the entire length of the deal. So if it's a 5-year plan, I want to see a fixed interest rate for at least 5 years, preferably longer. But you can't always get that. So you've really got to understand the debt and does the debt make sense for their business plan? And then the downside planning, this is what if the what hits the fan? What if everything goes wrong? What is the downside? What is the worst case scenario? So in this, you're really looking for what's called a sensitivity analysis. What if they don't get the rents? What does the business plan look like? What if they have a bad cap rate, right? That they're not expecting, right? What does that look like? What does that do to your investment? The biggest thing I look for on risk mitigation and risk management is room for error. Basically, how badly can they screw this up and it still works? All right, so let's talk about direct syndication into a single property, right? So the cool thing about these is you can have a direct relationship with the sponsor and you get exposure to a single asset. In comparison to what would be called a blind pool fund is really what this is comparing this to. So a single asset is where you're investing in one specific property. You know exactly where the money's going and you know exactly what it's doing. A blind pool fund is something more like, let's say we're going to buy 10 apartments in Phoenix with these metrics. So you don't know which property they're buying necessarily. You just know they're going to buy Class A, built in 2000 to 2020 in Phoenix, and they're going to be 100 to 150 units, right? And so direct syndication has a lot of favor because, again, you know exactly what you're getting yourself into. What I do is very different. I use this thing called the funds of funds investing. And what this means is when somebody invests with me, they're investing into my fund, and then I take that fund and I move it into another investment, usually with a higher minimum, right? So a lot of the deals that I'm going into have a $1 million or a $3 million minimum. And what I'm able to do is to provide you access to these deals at, say, a $50,000 minimum. So you get exposure to these significantly higher returns or significantly higher investments with a much smaller minimum. I personally think this is the way to go. This is the most safe or most secure and most legal way to do these types of investments on my side. All right, so you got to really just choose what works for you, is really what this slide comes down to, right? Do you want to work with a direct in syndicator, or do you want to work more on the fund of funds model? But really, the goal, right? The goal is really what we're here to talk about today, and that is diversified exposure. This says real estate, but we do a lot of these different types of investments in businesses and debt funds, you name it. But these are the four things that you really are looking to accomplish right here. Preserve your capital, generate reliable income with great tax benefits, and build long-term wealth. That's really what it comes down to. So friends, if you enjoyed this webinar, first of all, please tell your friends so we have more people on here next month. This is all of my contact information right here. And if you scan this QR code, you can actually download a 7-day passive investor course, totally free, which deep dives into more of these topics. And you can even book a call and get right here into my investor list with this QR code. So scan this QR code. Let's connect. All right, friends. Don't see any questions that have come up in the chat. So we'll go ahead and close out for now, and we'll talk again next month. Thanks, friends.